Good afternoon, ladies and gentlemen. Thank you so much today for taking off time to listen up to me and let me share regarding my loan business. As an introduction, I'd like to share with you regarding my background. I have been a private banker whole life in Singapore for the last 2 decades in several Swiss banks, and many of my ex-clients were listed companies owners that frequently will come to me and say to ask for share financing against their own shareholdings to my banks. So way back before 2008, the financial crisis, the banks I work for example, UBS, they were more than willing, because to foster a better relationship with the bank, they would actually grant small facility lines to the shares, secured against the shares to the shareholders as my customers. This worked very well until 2008 when the financial crisis happened, and many of the banks do not want to finance such share financing anymore, and many of my clients were told to either refinance or leave the bank and so forth. So until now, the whole structure of the bank, the banking industry has evolved such that many of the banks do not want this kind of share financing. Even if they do, they are looking at shares that are like close to blue chips and very often neglecting the small to mid-sized listed companies. So this underserved market is where our sweet spot is. So this is where I come from, and with the credit skills and the expertise that I've learned from my private banking days, I apply all these to my business model at the moment. So for the last 7 years, I've been out doing this business, and throughout these years, I have set up 2 funds which are licensed and regulated by the central banks. The first one was in Ireland a few years ago, and the recent one is in Singapore just this year. Both funds were launched and with good results. Let me further ado to introduce to you my stock loan private credit fund. It is called Charismatic Debt Equity Fund. As you can see, because my Irish fund already ongoing, so I would have to share with you that I'm putting a lot more effort to have my Singapore fund to expand its balance sheet after its launch in early August. To iterate, we don't do anything that is too complex. We are actually been doing a very traditional business that once the bank they did it, but now for many years since 2008, many of the banks shun this market. To them, they would rather use their balance sheet well because of the Basel III, the cost of funding is high. So they will rather concentrate on loans to big boys, to big clients, and to earn a decent margin than to spread themselves too thinly and use their balance sheets for stock financing. This is where they're coming from. And in fact, because of the COVID-19 that has been ongoing for the last 2 years, many banks have bad experiences with bad debts and delinquent loans, such that they have further tightened their credit. So because of all these happenings throughout all these years, we as a private lender in a regulated and licensed space, we're very privileged to cater to many underserved companies, shareholders of these listed companies that come to look for us. In fact, with the shakeup in the China industry, the China market right now, many of the liquid stocks, for example, that has market cap of more than 1 billion came to seek looking for us for share financing. So as a private lender, I believe in doing ethical loans and behaving ethically and responsibly to our investors as well as to the borrowers. Just a quick overview of how we evolved in terms of these private lending space. I first set up my Irish fund a few years ago. It was well received. And then because I've been in my Singapore for the last 2 years, not able to travel, just like every one of us, I've decided to launch a second fund in Singapore that is similar to the nature of Irish Fund, and we specialize in single stock financing. Based on our past experience, our track record has been good. We have been achieving around 10% net return per annum. And because our fund is a close end of 3 years, so investors will expect about 30% at the end of 3 years. You can check it out on the news. We were, publicized in Bloomberg a few years ago, as well as my recent interview with CNBC. So as mentioned, opportunity is abundant for us because of this. In fact, with this COVID-19, many of the listed companies, not to even mention private companies, many of them have become cash strapped. So for example, they have projects that they want to embark on, and for example, and they have like companies to acquire, or even for short-term capital working purpose, they need all cash. And because the banks are not willing to lend to these small mid-sized companies, many of them have to turn to us, private lenders. And in private lending space, many of these private lenders are sometimes can be a one-man show. They're very fragile. They're very fragmented. So we, as a regulated lender, we are actually have our own reputation and a good name to it in the market for all these years. So you may ask why, as a listed company owner, they can easily raise capital through the capital market, such as share placement or bonus issue shares or other means, or issuing bonds and so forth. Yes, that can be done, but many a times when the market sentiments are not good, many a times they are not able to raise as much cash, or in fact, they may be struggling to raise money through this kind of capital market instruments. And then that's the reason why many of them turn to us, because we have very quick turnaround. For our loans, we can be as quick as 1 month to about 2 months. With the pledge of the shares, we're able to grant them the loans effectively and efficiently. So sometimes when borrowers are in need of cash within a short span of time, and only, for example, a bridging loan of say 6 months to 1 year, they will rather come to us than to raise money through the capital markets. As a private lender in this stock financing space, we have lots of competitive advantages. First of all, as I've mentioned, many of these private lenders, they do not have the balance sheets, so they can only offer which is change of ownership shares. And because these borrowers are major shareholders, many of them do not want to go through the route of changing ownership, because that will paint a very negative picture in the market. And the market may think that, you know, the shareholder, the chairman, the CEO, they want to pare down their stakes, and that will be very negative to the public. So instead of changing share ownership, they will opt for pure pledge of the shares, which we cater to this demand. And because of that, we do not charge low. We actually command a premium to our loan rates. So easily, for a typical case, we would have a gross return of 15% per annum. And yet many borrowers are turning to us for the financing. So you may ask, why Charismatic Debt Equity Fund? Why not other lenders? First of all, we are, again, to iterate, we are regulated. So it gives a peace of mind to many of these borrowers who are seasoned and a veteran, high net worth individual shareholders that's dealing with a regulated lender. First of all, you know, the shares that they pledge to us are in good hands. At the same time, we are definitely, because we are regulated, so they have altogether a great peace of mind to deal with us. And they also be ensured that at the end of the term loan, when they repay the loan, they'll be ensured that there is a full redelivery of the shares collateral back to them. So that gives them lots of assurance to deal with us as a lender. Of course, for my Singapore fund, a big booster to us is that our stock loans are now insured by leading established insurance companies like Tokio Marine, as well as Malaysian Reinsurance Berhad. So as far as investors are concerned, their capital is preserved. For example, if there is a default case, which of course to date we don't have, and because we have 3 times share collateral, and even after selling the share collateral, for example, we are not able to recover the loan, there's still some shortfall to it. This shortfall will be well compensated by the insurance. So that's why when I say that the capital is preserved, this is the whole rationale of it. So we are tapping right now on the underserved, neglected segment, whereby most of the financial institutions, including broking houses, do not want to cater to this small, mid-sized listed company share financing. So we are in very good spot, and I believe in the long term we will still be expanding, because there'll be more and more IPOs, there'll be more and more of such demand, so long as the banks, the broking houses are shunning this area. And because of my background as a private banker, I've established a big network of intermediaries. Most of them are from the finance profession. So for example, private bankers, lawyers, accountants, PR firms, they have all the end clients. And their dealing with us have all been very good. That's why they keep referring businesses to us. And we would rather deal with intermediaries to get the loan referrals than to directly deal with the owners. Because at least they have filtered through and they will know what kind of criteria we have, what kind of borrowers we expect to. At the same time, technology is evolving quickly in every area of our life. So we also have adopted technology in terms of our lending business. So whenever there are loan referrals, be it from intermediaries or from borrowers themselves, we have an online portal which they can log in and put in their loan request, so that our team, our credit team, will pick it up immediately, and then we'll follow up with a call to them with our indicative terms. And then once the borrower accepts verbally, we can go on to do a due diligence process like KYC and eventually the loan documentation. So all these will be all uploaded in our portal and back to the intermediary and to the borrower. So all these are encrypted and very secure, and we do our protocol is to everything to be centralized and prim and proper, so that it can be easily followed up and tracked. So this is our investment selection process, ranging from starting with how we originate our loan. We never outsource, because our own network, we have our own sales representative in our core markets, although we do consider all globally listed stocks, except those stocks that have capital control, we can't. For those countries that do not have capital control, we will always consider. Our concentration is still very much in Asia. So our core markets are Hong Kong, Indonesia, Singapore, and Thailand. So all these, we have a local representative that bring all the deal flows to us constantly. So as an investment selection process, we are prudent. And because of our experience in stock financing and in our credit underwriting, we look at every step in details. We do our very in-depth due diligence. Yeah, and our KYC, we actually subscribe to Factiva, whereby we do word searches on the issuer, on the borrower, and as well as the guarantor. Because for our loans, we mandate that borrowers have to have personal guarantee to our loans. In every aspect of investments, there is risk management, and I pride myself that we have done a good job, because up to date we have 0 default cases. So let me share with you how we exactly control our risk as a financier. First of all, we do not have big exposure to every single stock that we execute on. Our exposure is maximum 5% of the market cap. And because we have a steep discount of 70%, so which means that every exposure to every stock is only 1 to 2%. The reason why is that so is because if should there be any defaults, for us to dispose of and to liquidate the shares will take just a matter of days. So that will protect our position as a lender. At the end of the day, the risk counts, and then our main objective is we need to recover the loan as soon as we can so that we do not lose on the capital. And of course, then in that case, we try not to activate our insurance, although the insurance may be in place. At the same time, for example, our sweet spot of loan ticket size is between 5 to 25 million. So for bigger size, like anything above 10 million, we will break it down into a few tranches of loan. We will never disperse in one lump sum for prudency. So we will actually disperse in tranches on a weekly basis. Just in case the stock volume dries up or the stock price plunge, we can always terminate the tranches going forward. So that gives us a lot of leeway and control in terms of our exposure to a single stock. Just like any other banks, when we do loans, we do have margin calls as a mandatory mechanism to control our risk. So for every stock loan, once the share price in any trading day dips by 10 to 20%, we have the right to call on a margin call on the borrower, and we will only receive cash as the margin top up. So we give only 2 days for the borrowers to top up in cash, filling which by the third day, if nothing hears from them, we will instruct the custodian to force out all the shares as soon as we can to recover the loan. In addition, our additional collateral will be the personal guarantee of the major shareholder, which usually in the case is a chairman or the CEO or the major shareholder. So although they may be cash poor, but in actual fact, they have very high net worth, and we do a very detailed due diligence on them. We know their net worth, we know what kind of assets they own. Yeah, and then of course, they have to sign a personal guarantee agreement with me so that we can enforce on them if we cannot recover the loan, in spite of the insurance in place. So as mentioned, on top of everything else in due diligence, we have spent quite considerably to get renowned lawyers to draft our loan template so that we're all covered in all aspects, legally speaking. And for every market that we do the stock loans in, we have local lawyer to adapt the master template into the local context. So 1,000 words can never beat a picture. So this is a very simple share financing example. So for example, let's say a borrower wants to take up a 5 million loan. So our terms will include a 15% loan interest, for example, and that our collateral is at least 3 times. In this case, it's 70 million worth of shares that they have to pledge to us. And after which the borrower has to service the interest monthly to us. And then we expect a loan amortization of 30% on an annual roll basis. So as far as we are concerned, it's a 3-year loan, but the 3-year consists of 3 times of annual rollover. So after 1 year, even if the borrower decides to request for extension of 1 more year, it's still subject to our approval. And if for some reasons we decide not to renew, we will accelerate the loan and get them to repay the loan after 1 year. Yeah, so either a 30% loan amortization at the end of 1 year, or alternatively, we can request the borrower to pay us a monthly installment over 36 months period. Regardless, our principal repayment, the principal repayment has to be repaid over the term on top of the loan interest. So for example, let's say if margin calls, if the borrower does not adhere due to price margin call or due to trading volume margin call or due to FX margin call or any other margin calls, that's released in the contracts, we have the rights to force out all the shares should the margin calls not be rectified. In this case, if the price dropped by 20%, the shares are worth still 13.6 million. So even after selling the shares within a short period of time, we're able to more than cover the 5 million. And the excess will be paid back to the borrower after netting off all the related liquidation charges, including any liquidation default rates to us. To iterate, our 4 main markets are still in Asia, being Hong Kong, because they have the most candidates with the most liquid and the eligible stocks that we can consider. The second comes Indonesia, and the smaller markets are Singapore and Thailand. But having said that, we do have requests from as far as US, Canada, UK, Middle East, Australia, and so forth. So as a lender, I believe in risk control. Yes, it's lucrative to do a stock loan, but at the end of the day, we look at the risk itself. See, it's rather worth the while to execute the loan. So coming to a conclusion, I now share with you the partners, the business partners that that my fund works with. Basically, we highly select those that are established and they are strong fundamentally, because to partner with us, we just have to ensure that the counterparty risk is minimized. So our main banker is OCBC Bank, the 3rd largest in Singapore. And then as well as UOB, their established brokerage house is UOB Kay Hian. These are all our custodians for the share pledge. As well as Hong Kong, Yuanta Securities, which is a well-known Taiwanese brokering house that has many presence, that has a lot of presence in the whole world. They also own a Taiwanese bank. As well as Goldman, and the China-owned securities house called Industrial Commercial, as well as a family office, and another Taiwanese securities house called KGI, and the largest Japanese bank, NUFG, and as well as Nomura. So the fund details is in this slide. So basically, we are just a 20% performance fee, 2% rule, very similar to hedge fund. But of course, if the amount is bigger, it gets cheaper. And our performance fee is only achievable when we hit average hurdle rate of 6%. So it's a 3-year lockup fund, and we do not expect investors to redeem unless it's emergency, subject to approval, and unless we have liquidity on hand. Should any borrowers prepay early, that allows us to allow the investor to exit early. But other than that, it's very hard to adhere because we grant loans and we cannot recall the loans unnecessarily. This is my introduction. So as mentioned, I have been in private banking for the last 20 years and worked for several banks, including some Swiss banks. Kenneth is crucial to our team because he's one of the stock equity analysts that assesses all stocks that come to us. And from his recommendation and reports and findings, our credit committee will decide whether to take on a stock loan or not. Andy and Patrick are our fund managers. They hold the license to the fund. So they deal with our MES in terms of compliance matters. We do have an advisory board comprising Paul, who is a veteran ex-banker. He has been with Citibank for a long time, as well as HSBC. In my Irish fund, we had Ian Morley, who is a reputable finance figure in the UK finance sector and the hedge fund sector. And the Irish fund had also Mark, who is a very veteran legal counsel to our fund in Ireland. On top of that, in Singapore, we have another board advisory who is Anthony Ang, who is a renowned finance figure in Singapore too. And not to forget our hardworking sales team. So we have 2 representatives in Hong Kong. We also have one in Indonesia. They bring us the deal flows. So the intermediaries through these countries will go to them and then from them to us. Thank you so much for the time accorded, and feel free to ask me any questions through the smart money system, or you can WhatsApp me or email me or even WeChat me. Thank you so much, everyone, and have a good day. Thank you.